Well, it's a real pleasure to be here in Australia again, even after a very long flight. Uh, the the subject, I almost am tempted to start talking about the risks of your government to Australia, even though, as I always say, I don't want to interfere with other countries' politics. But in the case of what's going on in Australia, it's hard to resist. So I will resist, though, for a few minutes, and I do wish you a lot of luck because you'll need it. I should just on the one theme that you mentioned, America's private for-profit universities have been an utter disaster, and it's something that one should always remember. We have good non-for-profit universities, Columbia University, Harvard being among them. We have essentially no good for-profit universities. They have excelled in the ability to exploit poor people and to take advantage of government loan programs and resist the attempt to have effective regulation of these for-profit universities. So it is something to be aware of the failures in the United States. But that's not the subject of this afternoon. The subject this afternoon is global financial contagion. Have the risks been contained? The crisis of 2008 has brought in a light on many of the basic ideas of economics, macroeconomics particularly. I'm going to talk about those. But then I'm going to go on and look at one particular issue, and which got insufficient attention before the crisis, and that is the risk of contagion, a problem of one country becoming a problem in other countries. It's interesting that before the crisis, the argument was that interconnectivity reduced the global risk. In fact, after the bubble broke, the housing bubble broke in 2007, Ben Bernanke, who was the chairman of the Federal Reserve, was asked, "Are you worried?" And he said, "No, because we've diversified the risk." And he went on to say the risks are contained. Now, I don't know whether he was just trying to buoy up the market or whether he was as foolish as he seemed to be. And I'll give you some suggestion about which interpretation I think is correct in a few minutes. Modern macroeconomics, I think, has really been shown to be basically very flawed. I didn't predict the crisis, and the test of any model, any scientific model, is prediction. But it was worse than that. It didn't predict the crisis, the most important economic event in 75 years. They actually asserted that bubbles can't happen. And the reason they said that was that there was underneath these models is the belief that markets were efficient and stable. That basic assumption that there were rational individuals with rational expectations. They involved representative agent models, which meant that there were no problems of information asymmetries, no problems of externalities. If you have a representative agent model where everybody's the same, the only way that you can have an information asymmetry is if you have acute schizophrenia. So the left hand of the brain doesn't know what the right hand of the side of the brain is doing. And if you have that acute schizophrenia, it's hard to reconcile that with the other hypothesis of infinitely rational individuals. So there was a basic sense in which these models could not address the fundamental problems of what I believe of facing the economy, information asymmetries, You also can't have problems of externalities, because if you have only one individual, you can't have an effect on other individuals. So, in a sense, the models were designed not to illuminate the critical issues of our society. But even more, you can't have financial markets if you have a representative agent model. Because if you have only one person, who is he going to be lending to? And even if you lend himself money, if you lend yourself money, there's no risk of non-payment. Because if you don't repay, who are you not repaying? You're not repaying yourself. So there's a fundamental sense in which problems of bankruptcy, credit markets, banks simply can't exist. It's not that they weren't incorporated in the model. The structure of the model meant that you could not use that model to study these problems. To me, one of the most striking things was that central banks used models in which there were no banks. And if those models were correct, the central banks which were using those models wouldn't exist. So the level of intellectual incoherence in modern macroeconomics is, I think, really deep. There were also strong mathematical assumptions, I'll come to that a little bit later, strong assumptions of concavity, which have important implications for risk diversification. And a lot of the analysis was based on these mathematical assumptions without their even understanding what those mathematical assumptions were that they were implicitly assuming. What was also striking about these models was that they were inconsistent with historical evidence and microevidence. You know, capitalism since the beginning has been marked by large economic fluctuations. And yet these models said that fluctuations didn't exist, or that if they did exist, they were a result of exogenous shocks, technological shocks. But if we looked at the history of economic fluctuations, most of them were endogenous. Stock market bubbles that broke, the technology bubble that broke, and yet these models said that the only source of perturbations in the economy were exogenous. So in a way, it was, to me, striking that these models gained such popularity. This is an aside, but I think the reason is that they satisfied or consistent with a particular ideology. The ideology said markets worked well. People wanted to believe that some people wanted to believe that markets worked well because with those models, there were some certain policy implications. The policy implication was the government was the problem, not the market. So it's not surprising that policies based on full models were badly flawed. For instance, if you turn to monetary policy, the policy framework suggested that keeping inflation low was necessary and almost sufficient for stability and growth. Suggested that governments didn't have instruments to prevent bubbles. It was cheaper to clean up the mess after the bubble broke. All of these assumptions have been shown to be wrong. Keeping inflation low did not ensure the stability, the macro stability of the economy. The government did have instruments. It could, for instance, have easily prevented the growth of the bubble, the housing bubble, just by engaging in macroprudential regulations like restriction on down payments relative to loan-to-value ratios. And the interesting thing is that Congress in 1994 in the United States had given the Federal Reserve the ability to impose those restrictions. And one of the members of the Federal Reserve, Ned Gramlich, had argued that there was a bubble and given evidence that there was a bubble and showed how it could be done. But the ideology of people like Alan Greenspan and Ben Bernanke said, no, markets are efficient. Let the party go on. And as I say, they said, anyway, if we use these instruments, it would be interfering with the efficiency, the wonders of the efficiency of the market, and better to clean up the mess. The cost of the U.S. economy as a result of this and the shortfall between our actual GDP and our potential GDP, where we would have been, is now close to $10 trillion. Few individuals could have imposed that kind of cost on our society. And even after the bubble broke, economists like Ben Bernanke claimed the effects were contained because of diversification. That diversification had spread risks, in effect, dissipating them. Maybe I'm getting ahead of the story, but we talk about of contagion. And I'll come to that in a few minutes. About the word contagion is borrowed from epidemiology and contagious diseases. And we recognize the risk of contagion. The IMF talked about contagion for well before the East Asia crisis. They talked about contagion. So it was a well-recognized idea. But this kind of intellectual incoherence never meant that they never thought about contagion ex ante. They only thought about it ex post. But think about the context of diversification. Think about diversification in the context of a contagious disease. The recommendation of the IMF and the U.S. Treasury would be if somebody landed, say, in New York City, a group of 30 people landed in New York City with smallpox. The diversification strategy would be what? To send one of them to each of the states in the United States to diversify the risk. Well, we know that would not be a good solution. That is a way of spreading the risk. But that's what the models that they used said. And not one of them thought about this ahead of time. Now, if any of you who know mathematics can figure out what was wrong in the mathematical models, and I'll come to that a little bit later. They also thought that risks were contained because the economy has their belief in the market economy said there were strong buffers, inventories, price adjustments that will enable the economy to absorb the shocks. But again, anybody who studied the history of macroeconomic fluctuations know that, in fact, some of these buffers often act as amplifiers. That inventories in general are amplifiers of risk, inventory cycles. And so rather than the faith in these buffers, they should have been focusing on the systematic ways in which modern economies often amplify risks. Well, it's not a surprise, given the flawed models, given the absence of a financial sector in the models that were used by central banks who are supposed to be focusing on finance. It is not a surprise that the response to the crises have been inadequate. We're now more than 5 years after the crisis, 6 years after the bubble broke, and the U.S. economy, the global economy, is really not back to normal. I have to, mention when I was here in Australia a few years ago, I always got reminded in discussions of the global financial crisis that the correct name is the North Atlantic financial crisis because it did not hit Australia. So when I say the global financial crisis, I apologize. It really is the North Atlantic financial crisis. But in the North Atlantic, the crisis is still present. Just to give you a few numbers, most of the countries in Europe today have a GDP well below what it was in 2007, GDP adjusted for inflation, GDP per capita below what it was. It is a downturn that is as protracted as the Great Depression. the shortfall now between, if you draw a trend line of where our economy would have been if we had not had the bump in 2008 and where it is today, for the United States is over 15%, and no evidence that the gap is narrowing. In other words, the trend line is going there. We had a bump down, and we're now approaching trend, but 15% below where we would have been. In the case of Europe, it's almost 20%. And the gap is growing in the case of Europe. Growth in the United States this year is expected to be just a little over 2%, barely enough to create jobs for the new entrants into the labor force. In Europe, average unemployment is 12%. Youth unemployment in countries like Spain, over 50%, Greece, over 60%. You can imagine what that is doing to their societies. I could go on and try to describe the various failures of the model, but the most important one for purposes of this talk is that the standard models didn't focus on credit and therefore didn't have much to say on repairing the credit systems. Credit entails differences in individuals. Some are borrowers, some are lenders, and asymmetries information. Lenders don't know who are good borrowers. Before the crisis, there was actually some work that had been done that would have provided micro foundations, theories of banking, but it's remarkable that the models used by central bankers had little to say about these about banking and didn't incorporate the work that had been done. They also had little to say on the inherent deficiencies in securitization. And I'm not going to go into this in some detail. If we have time in the question period, we can go into it. But that was supposed to be one of the big innovations. But securitization presented some real problems on the incentives for the efficient gathering of information and efficient issuing of mortgages and other securities. So it really illustrates in a way how the gung-ho nature of the advocates of markets focused on one set of problems without looking at another. So they talked about securitization as being this great thing of spreading risk, diversifying risk. But if there were no consequences to risk, then what are the incentives to avoid getting risk? And so their implicit assumption was that there was perfect information and that people would have incentives, would somehow not undertake excessive risk-taking, that they would only issue good mortgages. But given the incentive structures, there was no incentive not to engage in bad mortgages. You want to be able to issue the worst mortgages possible at the best rates that you could. And so the system really was perverse. And after the crisis, Alan Greenspan was asked to testify to Congress what had gone wrong. And he famous testimony, there's been a whole movie made about it, where called The Flaw. I don't know if you've seen this movie, but he said there was a flaw in his reasoning, minor flaw causing a few $1 trillion but there was a flaw. And the flaw was that he thought bankers and markets would manage risk better. And he was surprised. But I was surprised that he was surprised. Because anybody who studied microeconomics, looking at the incentives that were built into the system of securitization, the system of banks, would say that they had incentives to behave badly. And if they didn't behave badly, we'd have to rewrite our microeconomics textbooks Fortunately, we don't have to rewrite. Incentives do matter. It's the one thing economists agree on. And we created an incentive system that had incentives for the kind of bad behavior that we saw. And they did exactly in a way that was predicted and predictable. Now, that raises the question, why is it that we had such bad incentives? And that's beyond the topic of this talk. One of the books that's for sale out there is Free Fall, and I talk about that. It has to do with problems of corporate governance, agency problems, but and it has to do with these problems of securitization, which undermined incentives. But what was so striking is the extent to which this model of securitization was sold as a way of reducing risk. And that was because, in some sense, a lot of people were making money out of this particular model. And they wanted to talk about the benefits without talking about the cost. There are other lessons that come out of the crisis. One of the things that traditional macroeconomics had emphasized was the importance of wage rigidities. And if you listen to central bankers like Trichet in Europe, they never like to talk about monetary policy. It's one of the characteristics of central bankers. They like to blame others for the problems in macroeconomics. I think it's totally understandable, given how bad a job that they've done. But so when they look around, they say the real problem is labor markets. And what we need is to lower wages, create a little bit more inequality, make the people who are suffering suffer a little bit more, blame the victim. There's a whole rhetoric to this. And if you're a central bank, those of you who aspire to be central bankers, you have to learn that rhetoric of that it's wage rigidity. Well, one of the consequences of the crisis has been to show that that's wrong. The United States had one of the most flexible labor markets, and we had a much higher unemployment than, say, Germany. And it showed that something else was going on, and labor market flexibility is not enough. What we observe, though, is, of course, is consistent with earlier studies of economic volatility. One of the, I won't say paradoxes, but one of the important things to observe is that while there were large losses associated with the misallocation of capital before the bubble broke from the behavior of the financial sector, most of the losses that have occurred in terms of the gap between potential and actual GDP that I talked about, the $10 trillion, most of those losses have occurred after the crisis. And that raises a question. If you look at our standard theories, there's no reason that we should be persistently below our potential. Even debt, if you look at our standard theory, doesn't explain bad performance. After all, what is debt? Debt, it just means that somebody owes money to somebody else. If you looked at those standard models, the fact that I owe somebody else money, that's just a redistribution. The debt isn't, you could say to a little bit, if people in one country owe money to another country, it lowers the standard of living in that country. But again, it's not a reason why you should be not using your resources fully. It's an explanation of why you might have a lower standard of living, but not why you should be wasting resources and leaving it idle. And ironically, the models that we've used have typically focused on wage and price rigidities. But what have we been worried about more recently? Deflation. Everybody worries about deflation. What are we saying when we worry about deflation? We're worried about wages and prices being excessively flexible. Well, that just, I can give you the answer what's wrong with these different models, but what I want to emphasize is the kind of intellectual incoherence that is present in the models. The models were based on wage and price rigidities, but as soon as we start having a lot of flexibility, we get anxious. And what we're saying is we don't really believe those models. They were used by central bankers and by macroeconomists, but they really don't capture what is going on. In a minute, I'm going to talk about a second aspect, which is the increased interdependence has led to more financial fragility. So that's one of the things that's happened over the last 20 years is that, in fact, while we thought we were working toward a better economy, we were actually creating a more fragile economy. Another paradox of what has happened is we thought we understood the economy better. If we had a better economic structure, which we've been working for, and we have a better understanding of the economy, which we think we've had because of all the research that all of you have done, what should happen to economic performance? It should get better. But what have we had? We had the largest economic downturn since the Great Depression. Well, that leads to the question, what is really going on? Why is it that we haven't been performing as well as we should? That's a big topic that goes beyond the subject of this afternoon. One aspect of our poor economic performance has to do with the growing inequality, which again has to be explained, but there is now an understanding that inequality does have adverse effects on macroeconomic behavior. The IMF in its spring meetings highlighted the growing consensus that inequality has adverse effects on the economy. Again, you can't study inequality in a model of a representative agent with one person. You have to have meaningful heterogeneity. A second reason is that the global economy is undergoing a major structural transformation. 100 years ago, 80 years ago, we were going through another major structural transformation from an agriculture to a manufacturing economy. Now we're going from manufacturing economy to a service sector economy. We're going through a structural transformation associated with globalization, where global comparative advantage is changing. Markets on their own don't manage these structural transformations very well. And in some other research that I don't have time to talk about today, shown that these periods of structural transformation are often associated with extended periods of underutilization of resources. And that has to do with capital market imperfections, that those whose assets become less valuable as a result of the structural transformation, human capital or even physical capital, don't have the capital to move into the sectors where there's new demand. And without government support, they are trapped in the old sectors. And as income in the trapped sector goes down, demand for goods in the growing sectors is limited. And so you get a rigidity, but a rigidity that's not a wage and price rigidity, but a rigidity caused by the inability of resources to reallocate themselves in the absence of government support. We solved the problem of the Great Depression. How? Well, it was not a very good, pleasant solution. World War II. It was government spending. You can imagine the government spending could have been done to create a more stronger economy. It wasn't the best way of spending money to drop bombs, but we had no choice. But it was government spending that got us out of the Great Depression. But unfortunately, in many countries, the United States, Western Europe, and now Australia, things are going just the opposite. Rather than having the government support that is necessary for the structural transformation, including in the education system, we're cutting back. And even more troublesome Now, because the sectors that we ought to be going into, I would say the service sectors, what are the service sectors that people really care about? Education and health. For good reason, these are sectors in which government traditionally has played a large role. So that the necessary role of the government to facilitate the transformation is even more important today than it was in the Great Depression. The second part of my talk I want to talk about is does interconnectivity lead to more or less systemic risk? And this is a key question in understanding this crisis, because failure in one financial institution led to failures in others, to the point where the system was at risk. And when I say financial institution, it wasn't just banks. The failure of Lehman Brothers was a critical factor, but the failure of Lehman Brothers then led to the potential failure of AIG, and the failure of AIG would have led, people worried, to the failure of Goldman Sachs. And that's all you all know, once Goldman Sachs was dead, would have been dead, the US was all over, at least as viewed by the former officials from the Goldman Sachs, who were very influential in the US economy, government at the time. So AIG had to be bailed out to the tune of over $150 billion. More money we gave to one company in corporate welfare than we gave to all the poor people in America over a decade. It shows you values. That we said we didn't have money to pay for health care for poor children just months before we found $150 billion to pay for a sick insurance company. And it was not true that we had to do it in the way that we did. Interesting book that's come out recently by Geithner trying to defend what he did, called Stress Test. And what's remarkable about the book is how unconvincing the case is that he made. Hundreds of pages of trying to defend the indefensible, and not surprisingly, he failed. But we can go into that in the question and answer period. The standard answer, as I suggested before, is diversification. Diversification with concavity leads to better outcomes. But the problem is that economic systems are rife with non-convexities. The basic principle of concavity is diminishing returns, but with bankruptcy, learning curves, there are a whole array of information constraints, incentive compatibility constraints, collateral constraints, self-selection constraints. All of these result in non-convexities in the non-concavities in the structures. And the result of that is that diversification can spread risks rather than reduce risks. And that's a really elementary mathematical insight, but one which economists have not really taken on board. And that's because the models which we have always used have just assumed the concavity. They're used, when I say used, in macroeconomics. And other branches of economics, we've been very aware of these non-convexities. So the result of this is that interlinked systems are more prone to wide failures with huge costs. And this crisis illustrates that. If you have separate electricity grids, there's a cost, an inefficiency, because if you have separate grids, different states at different grids, you have to have enough generating capacity in each part of the system to absorb the shocks. And that's why there's been a long-term trend to try to get more integrated grids. But there's a problem integrated grids. Problem with integrated grids is if you have a surge of electricity in one part of the integrated grid, it can bring down the entire grid. Whereas if you have separate parts, the worst that happens is that little part goes down. And we saw that in the United States back in the 70s when we first began the process of integration, where a little substation in Ohio had an outage, and it brought down the total electricity supply in the East Coast of the United States. And I don't know if you remember, there's a famous episode because the birth rates went up afterwards, and so sociologists have studied the effects of a lack of electricity for a short span of time. But anyway, from the physical point of view, the point was that integration has advantages, but it also has disadvantages in that there's the problem of contagion, of a problem when one part of the grid to other parts of the grid. Now, in the case of electricity, we figured out how to manage that. We manage it through circuit breakers. Economically, in economics, there is an analogous concept, which is capital controls. A problem when you have an integrated system, a problem in one part of the system, you can stop it going into the others by saying, okay, normally we'll be integrated, but under certain circumstances, we won't allow that full integration to work. One of the things that happened in the crisis was that in some of the Eastern European countries where the banks were owned by Western European companies, when the Western European countries had problems, their governments effectively insisted that they take the capital back to the home country to protect the home country banking system. But of course, what did that do to the banking system in the Eastern Europe, the supply of credit in the rest of Eastern Europe? It made it much worse. Now, they could have prevented that if they said we have separate subsidiaries that are directly controlled by the regulator in the Eastern European countries. Then they could have said, I'm sorry, you can't take your capital back. So there are easy ways of dealing with this, but those had not been incorporated into the mindset of global integration, of globalization, financial globalization, because it was simply assumed that the more integrated, the better. So the basic point I want to emphasize is that just like well-designed electric circuits understand the risks as well as the benefits, so too well-designed integrated economic systems. But we've understood the benefits, but we haven't understood the risks, and we haven't designed the policies to deal with those risks. The key economic insight from the point of view of economics is that privately profitable transactions may not be socially desirable, that there are externalities. And this is a very generic result, that whenever there are incomplete risk markets, whenever there are information asymmetries, markets are not in general efficient. So we've turned on its head Adam Smith's invisible hand. The way I sometimes put it is, we now understand the reason that the invisible hand, the idea that that markets are led, the pursuit of self-interest leads as if by an invisible hand to the well-being of society. The reason that the invisible hand often seems as the reason the economy often seems as if it's not efficient is that the invisible hand is not just invisible, it's not there. And that's the basic result that now we understand for economies with imperfect information. The analysis of macroeconomic externalities, where the actions of one party have effects on others, as a result of the presence of information, incomplete information or imperfect risk markets, is now a huge field called macroeconomic externalities. And important work by one of my students, Anton Kornek, has shown that, for instance, in the absence of effective government regulation, there'll be too much short-term government, private sector indebtedness, particularly in foreign-denominated currencies. And so there's a need for regulation or taxes of foreign indebtedness as one example. Excessive borrowing or interconnectivity can make the system more volatile. And an interesting new branch of new set of mathematical tools have been used is network analysis has now become much more used to understand how systems of financial institutions interact with each other. Here I just emphasize what I said before. The standard macroeconomic frameworks were incoherent, and they argued for the benefits of a diversification before the crisis, and then they worried about contagion after the crisis. And the optimal system has to design has to balance the benefits and the cost. Full integration never pays if there are enough countries and that restrictions on capital flows, circuit breakers, are desirable. And there's now a large literature that is developing on the optimal degree of integration, the optimal design of interlinkages across financial institutions or across countries. Different financial systems have different structures, and looking at the design of those structures has become an interesting, important area of research. The impact of shocks depends on the size of shocks, the correlation among the shocks, how the shocks are distributed, and the architecture of the network. Architecture refers to whether you have, say, a central node with people linked to it or symmetric. These all turn out to be important. There's evidence, if you look across countries, that banking systems have evolved into a few concentrated nodes. Big nodes are interlinked. And this kind of architecture, which seems to have evolved across many countries, is good for absorbing small shocks. So if you have small shocks, fairly independent, the system actually does behave more stably with this. The problem is when you have a big shock, because when you have a big shock, then it's bigger than the big node can take, and when one big node goes down, the whole system goes down. So what we now begun to understand is that there are trade-offs, the ability to absorb small shocks versus the ability to absorb big shocks. And we created a system that was not good for accepting big shocks, and we created incentives for the economic system to create big shocks. So we created an architecture that made it both more likely that we would have big shocks and less able to absorb the big shock. I want to end on a discussion of where are we in the reform agenda. And the basic story is the glass is sort of 1/4 full and 3/4 empty. We've done some things. Things are better in some ways. In some ways, they're worse. And what I wanted to try to describe is the ways in which I think things are better and ways in which things are worse. The good news is that there is general recognition of the importance of systemic risk. There is an important research agenda in understanding the determinants going on in several central banks. UK led the way. The United States is beginning to do it. The IMF is beginning to do some important work. There are some improvements in capital buffers, some improvements in the regulatory regime. But there are some ways in which things have not gone well. The problem with too big to fail banks has become worse. And this is I know I hesitate to talk about this in Australia because you have big banks relative to your economy. There is a difference that if you have adequate regulation, you can live with big banks. Canada also did that. The real question is, can you have adequate regulation? And there is a political economy involved, which is the big banks don't like adequate regulation, and they give all kinds of arguments of the kind that were used before the crisis that I mentioned before that undermine the ability to have adequate regulation. What is the problem? I mean, in the United States, there should be no pretense that we have adequate regulation. We know that the Federal Reserve and the U.S. Treasury, I sometimes jokingly say, are wholly owned subsidiaries of the Wall Street. And an example of a difference between Australia and the United States, I think, is illustrated by the way you've handled credit and debit card fees. There being strong antitrust actions, suits on Europe, United States, and Australia. One of the provisions in these of the financial sector, which in the United States makes tens of billions of dollars a year off these credit card fees. Competitive industry is supposed to drive profits down to zero. When you see profits of tens of billions of dollars a year, it should be suggestive that it's not a competitive industry. And I think when you have restrictions like the restrictions that you can't charge, a part of the contract with the credit card and debit card is that you can't charge for the use of the card. They call it a no surcharge provision, but it's not a no surcharge, it's no charge provision. And Australia was the first to have a serious treatment of this, and now I find it so enjoyable when I go in and they say if you use a credit card, you will be charged. It's a price system actually working, not perfectly, but working, and it brought down even American Express credit card fees. In the United States, we left it to the Federal Reserve. In the Dodd-Frank bill, they had a provision only for debit cards, not for credit cards. They couldn't get the credit card provision through Congress if the credit card companies are so strong. But they got it one through debit card, but then they made a critical mistake. They gave it to the Federal Reserve to implement. The fee that the staff came up with was a multiple of what was a reasonable fee, but then the Federal Reserve Board doubled that. And then the court looked at this and said this was so outrageous that they threw it out. So we haven't gotten the final adjudication of it, but it shows that our central bank is not fully, we say euphemistically political economy problems. But the problem with too big to fail banks is obviously it's a heads I win, tails you lose situation. They undertake risk. When things don't work out well, the government picks up the losses. When they do work out well, they get the profits. Since the crisis, our problem of the too big to fail banks has gotten worse. The banks the response of the Fed and the U.S. Treasury to the crisis was to lead to consolidate banks. You take two bad banks and put them together, and the hope was that would become a good bank. I don't know how that happens, but that was the theory. So we have a more concentrated banking system than we had before. So the problem of too big to fail banks has become worse. But it's not just too big to fail, it's too interlinked to fail. I mentioned before that if you have strong linkages, one problem in the bank going down, one bank goes down and brings down the next bank, and the government, knowing that, bails out. So it bailed out AIG. Not because necessarily AIG was too big to fail, it was, but it was Goldman Sachs that it was worried about. So it's too interlinked to fail, but it's also a problem of too correlated to fail. If everybody's done exactly the same thing, which is what happens when you have universal banks, then of course, if one has a problem, it's very likely that others do. And so when a problem arises, it becomes a systemic problem. Major abuses of all the major banks, market manipulation, LIBOR, foreign exchange. I don't know if you followed robo-signing, where the banks were, in the United States, we have, quote, expedited ways of adjudicating foreclosures. So the banks would sign a statement that they had examined the records, send an affidavit to the court. They had examined the records. This person owes this much money, and on the basis of that, the court would take those affidavits and throw people out of their homes. Except the banks had not examined the records. The records were in shambles. But it was much easier to hire somebody to sign thousands of these a day than actually examine the records. So they were lying to the court thousands and thousands and thousands of times. Now they said, as they threw people out of their homes that owed no money, they said, well, most of these people owed money, or many of them did. So it was like a system of justice where we say, well, most of the people that we give capital punishment to, United States still has capital punishment, most of the people that we give capital punishment to probably did something wrong. We don't know whether it was with the charge that they were found guilty of, but they did something wrong. They were nasty people. So it's okay. And that was the attitude of our banks. And yet, not a single bank official was held accountable for this massive abuse of the rule of law. No discussion of this as an abuse of the rule of law. Well, I could go on, but we have targeted a number of foreign banks for large fines. But we are just getting around to imposing some fines on some American banks. Well, some derivatives have moved to exchanges, which may be undercapitalized and again represent a systemic risk, there remain problems of non-transparent over-the-counter derivatives. These are really persistent. And the magnitude of these problems was highlighted by the Greek crisis. I don't know if you remember the Greek crisis, and Greece had to restructure the debt. And the European Central Bank took a very peculiar position. You would have thought if you were a good central bank, you would want your banks to buy insurance against the risk that the bonds in their portfolio defaulted. And if they bought insurance, you would want to make sure that the insurance paid off. A big controversy. If you buy insurance, what do the insurance companies like to do? They like you to pay up front for the premium, but they don't like to pay you when the event happens. So these derivatives are very peculiar insurance policies because it's often difficult to tell whether the insured against event happened. So it's it's like the insurance company's brother is deciding whether you get to pay, whether your insurance premium pays. But there are some rules. One of the rules is if it's a voluntary versus involuntary event, Now, voluntary versus involuntary is a little bit ambiguous because if somebody holds a gun to your head and say, well, is it voluntary or involuntary? Well, the most peculiar thing about the ECB was that when Greece was restructuring its debt, it wanted to be sure that the debt restructuring was done in a way that the insurance policies didn't pay off. And you have to say, that's a little bit crazy. As a bank regulator, I want to make sure that insurance policies pay off because I want the banks to have insurance against the default on the assets that they hold, and I want them to have insurance and that insurance policy pays off. But the ECB took exactly the opposite view. And why? Well, partly because they didn't know who was writing and who was buying these over-the-counter derivatives. And they were afraid that Goldman Sachs or some other bank was exposed as a writer of the derivatives as opposed to a buyer of the insurance. And so they didn't know who had more risk. Was the banking system risk increased or decreased as a result of these derivatives? But that's a consequence of the lack of transparency in our system of over-the-counter derivatives, which persists today. As an economic theorist, one of the things that I find very strange is as we begin our, where do we begin our discussion of risk in the financial sector? We always begin by talking about the Modigliani-Miller theorem. That capital structure doesn't make any difference. And then we have refinements about taxes, we have refinements about information asymmetries, but the Modigliani-Miller theorem is the beginning of the discussion. And what's so striking is that none of the bankers seem to understand the Modigliani-Miller theorem, and yet they're supposed to be managing risk. Now, of course, from a short-sighted point of view, we understand what's going on. Banks like high leverage because higher leverage means that there is more risk which is absorbed by the government. It's part of the government subsidy. But they actually have been arguing that it makes for a more efficient system without any underlying economic theory to support their view. The problems of the shadow banking system are still not adequately addressed. Neither the Volcker Rule nor Vickers ring fencing is adequately implemented, and there is no adequate cross-border system of resolution of too big to fail banks. So let me just conclude very briefly. The old paradigm was wrong, and policies based on it contributed to the financial crisis and to the inadequate recovery. Diversification may make an economy more unstable. Financial architecture matters. An economic downturn related to structural transformation is different from normal economic fluctuations. This is not just a balance sheet recession. This is not just a recession that will be over as soon as we deleverage. There are more deeper problems that we have to address. And then from a point of view of for economists, models matter. Strong assumptions follow from strong conclusions. Strong conclusions follow from strong assumptions. Mathematical assumptions like convexities matter, networks and frictions matter. The old analysis was intellectually incoherent, focusing on benefits of interdependency at times and costs of contagion at others. What I've tried to do in this talk is very briefly to outline a set of models that provide a coherent, or at least a more coherent, and a better description of what has happened, and that provides the basis of policies that are more likely to lead to better economic performance. Thank you.
Christopher Game, you said that markets are not perfectly efficient. You've explained in detail how governments' inefficiencies have caused these crises. Why would the government, more government control, make these crises any better?
Well, in a way, I think the best way of understanding this is to think about drug regulation. We know that government regulation can be effective in testing whether drugs are effective and whether they have bad side effects. And that the nature of government drug regulation doesn't have to be as clever as those that originate drugs. You know, that has to, that basic research, basic science. But what it can do is do good testing to see whether it actually does what it says it's doing, and whether in fact it has side effects that make it dangerous. And there are
the regulation of amphetamines and drugs by
no pharmaceuticals. I was talking about pharmaceuticals. There's pharmaceuticals. No, in the case of financial sector, the basic point is a very simple one, that there are large externalities that poorly regulated financial systems can give rise to. And we see that repeatedly. And so we're not asking them to allocate capital among various borrowers, but we're just saying, make sure that you don't undertake excessive risk, impose risk on others. And because the consequence, $10 trillion is a lot of money to waste. And when you have a major financial crisis, it has major consequences. And the incentives of the individual bank or bankers, financial institutions, does not take into account these external effects. And it's just a sort of elementary context. Now, can it do it well? The history was that from the Great Depression, when we had the previous episode of excesses, and we passed in the United States a strong set of regulations, for more than 4 decades, things worked well, until we made a mistake. We thought because we didn't have any crises, the market on their own were working well. They were working well because we regulated. We started stripping away the regulations, and in the 3 decades following that, we've had over 100 crises around the world. So it was the predictable and predicted consequences of deregulation with huge costs to society.
Bit of navel gazing, our profession. I learned about incomplete markets necessary for an equilibrium on the west coast of the US back in the late 60s. And you'd know who taught. The question is, how come the milk came out on top of the cream? How come, in a sense, economics got subverted by finance? How should we structure our own industry to avoid these problems? Because it seems to me we are to blame, as you said at the outset.
Yeah, I say, the private sector was most to blame. The regulators are partly to blame because they didn't stop the private sector from doing what it's done over and over again. And the economists, or I would say other economists, are to blame because they provided some of the rationale for the regulators not doing what they should have done and for the private sector doing what it was doing. And to me, it is, I agree, a little bit of mystery because we have known about many of the ideas, not fully. We didn't fully understand how bad things were. We didn't fully understand network externalities until the last decade, and we've learned a lot. We didn't understand macroeconomic externalities as much as we do today. But why did a particular paradigm become dominant? Let me just make one comment on the role of the financial economist. There are 2 strands in financial economists, and one of them, even within finance, seems to have dominated. There was one modeling risk diversification and the other one focused more on information asymmetries, corporate governance, on the information problems. Unfortunately, the first one also dominated, where the efficient markets hypothesis, the a view that ignored the endogeneity of information, dominated over those that focused on the information asymmetries. So even within finance, there was a division into two different strands. I think it was a very simple, if I had to give an hypothesis, I think part of the two hypotheses. One is that the models with perfect information, focusing just on risk diversification, or even no risk, sort of in macroeconomics, the real business cycle, are much simpler. And particularly once you go into representative Asian, they were complicated enough to make people feel like they've learned something. And that's very important. You go to graduate school, you want to feel like you've done something. So they were just the right degree of complexity. So you could feel that you spent... Well, they felt that they have done something, you know, that they learned something. It was hard work, but they didn't ask, was it the right problem? So I think that there was a certain appeal, and being just difficult enough is important because you have to publish, and if it's too difficult, you can't publish. And it became a well-defined paradigm in which you could generate papers that your colleagues would appreciate because they could see how much work went into it, and therefore, so, you know, you were solving problems that were well-defined, irrelevant for the world, but you could get them published in journals, in reasonably good journals, in fact. So that was, I think that's part of the problem. The other underlying thing is the incentives from the financial sector. Many economists, I think, were bought that there's a notion, you know, called cognitive capture. The notion was that they would act as consultants, or they would on projects, and there were interesting problems. You know, I think most academics like an interesting problem, and even better if it's an interesting problem that's well paid. And so it was natural that they gravitate to where people were asking hard questions, interesting questions, and well paid. So I think there was that helped move things in that particular direction. You get that feeling a little bit. Have you seen the movie The Inside Job? Yeah, that gives you a little bit of the flavor of the second strand of explanation for what happened, and I think there's more than a little truth in that.